Welcome to the deep dive. We're here to cut through the noise and really get into the details that matter. Today, we are taking a close look at Indian Railway Finance Corporation, IRFC, specifically their latest financial results. These are for the quarter ending June 30th, 2025. That's Q1 of their financial year 26. And we got the official numbers, the press release, even the auditor's report right here, our goal. To unpack the key takeaways, maybe some surprising bits, and what this all signals strategically. We want you to understand what this quarter means, not just for IRFC, but for Indian Railways as a whole. Okay, let's unpack this. So the headline that really jumped out from their Q1 results was this claim: strongest ever quarterly performance. Big words. And you know what? We looked closer, the numbers really do seem to back that up. Their press release shouts about highest ever quarterly income and double-digit growth in profit after tax. Pat, let's look at the income. Total income for this quarter, Q1 FY26, it came in at Rs 6,918.24 crore, almost 7,000 crore. That's up from about 6,766 crore in the same quarter last year. And yeah, they're saying it's the highest ever for a quarter. Then there's the profit after tax. That jumped to Rs 1,745.69 crore. That's up from roughly 1,577 crore year on year. So a jump of what, 10.71%. And again, they're highlighting this is also their highest ever quarterly PAT. Pretty strong start.
It really is. And these numbers, they're impressive on their own, sure. But what they signify is, I think, more important. Their CMD, Manoj Kumar Dubey, he framed it well. He talked about the robustness of IRFC's financial strategy and also its critical role in advancing the infrastructure goals of Indian Railways. So it's not just about big numbers flashing up. It's about the quality of that growth, It suggests their core model financing long-term assets for a very stable client, the Indian Railways. It's not just working, it's scaling effectively. It really points to a very efficient use of capital to meet some pretty big national goals.
Right, that makes sense. So headline figures look great, but as we always say, the real story is often deeper down. How does this translate into their overall financial health? Tell us about how efficiently they're running things.
Okay, let's dig into that. If you look at their revenue from operations for the quarter, it was Rs 6,915.38 crores, so nearly all their income. And the breakdown is key. Lease income, that was a giant share, Rs 5,403.75 crores. That's their core business, financing, rolling stock, and infrastructure. Then you had interest income at about Rs 1,497 crores. So it paints a picture of a very focused operation. And speaking of operations, let's talk efficiency. Their net interest margin, or a DM, that improved. It hit 1.53% annualized. Now, for a financial company, NIM is crucial. It shows the profit margin on their lending, basically. And they're saying this 1.53% is their best in the last 3 years. That suggests better spread on their loans and good cost control. Plus, they maintain this reputation for having the lowest overhead cost in the industry. That definitely reinforces the idea of a lean operation.
Okay, efficiency metrics looking good. But here's where it gets really interesting for me, the bit that honestly stands out. Their non-performing assets, NPA, it's still zero. They have zero bad loans, a completely clean book. I mean, running a finance company this size without any NPAs, it's remarkable.
It absolutely is. And it's probably the key insight into how they operate. The reason for that zero NPA streak, it's largely structural. Their main customer is the Ministry of Railways. They're funding essential government infrastructure. So they don't really face the same kind of credit risks that, say, a commercial bank lending to lots of different private companies would. It's not just good management, though that's part of it. It's built into their mandate. It makes them incredibly stable. And you see this stability reflected right across their balance sheet. Their net worth, now at 54,423.96 crore. It's the highest it's ever been. And look at the debt to equity ratio. It's actually improved. It's down to 7.44. Last quarter was 7.92. A year ago it was 8.02. So for you listening, a lower ratio generally means less reliance on debt, which points to a healthier financial structure, more stable. They've even slightly reduced their total outstanding debt. It's down from about 407,000 crore to just under 405,000 crore, even when their assets grew. And critically, they maintain 100% security cover for their secured borrowings, an asset cover of 1x.
Basically, for every rupee borrowed, there's at least a rupee of assets backing it up. That's incredibly strong protection for lenders. Signals huge stability.
Wow, okay, so the balance sheet sounds like a fortress. But what about the actual cash moving around? How did their cash flow look for the quarter?
Yeah, good question. The cash flow statement, it shows strong generation from their main activities. Net cash flow from operating activities was positive, over 1,467 crore rupees. And they also generated significant cash from financing activities, nearly 7,000 crore. Now, you might notice there was a net decrease in their overall cash and cash equivalents during the quarter. They ended with about 172 crore. But it's important to see that in context. It's not really a red flag. It just reflects specific financial movements, like deploying capital.
Yeah.
Given their strong operational cash flow and ongoing financing ability, it's not a concern. More like active liquidity management.
Right, got it. So we've seen the record performance, the solid financial health, but the big question is always, okay, what's next? Where are they heading? And it seems IRFC isn't just resting on these strong results. This deep dive definitely hints at a clear strategic direction.
Precisely. And a key factor here is timing. This is the first full quarter since IRFC got that Navratna status from the government earlier this year. That status is a pretty big deal. It gives them, and I quote, enhanced autonomy and strategic flexibility in operations and investments, unquote. That autonomy is crucial as they step up to support Indian Railways' really ambitious infrastructure plans. They've been funding Ministry Railways projects since back in October 2015, mostly through a finance lease model, often with a 5-year gestation period. And interestingly, the auditor's report points out something about their proactive approach. For one major project funding stream called EBRIF 2019-24F, they actually started recognizing the lease income from late March 2025. Even though technically the final lease agreement itself was still under process when they reported, shows they're quite nimble, making sure revenue hits the books promptly. And this feeds into what CMD Divi calls IRFC 2.0. It's quite an ambitious vision. He talks about moving beyond just being the backstage financing role. It's about a broadening of scope and ambition with railway ecosystem. He described the growth path as involving the proliferation of assets in the whole of railway ecosystem, with backward and forward linkage to railway-centric project, unquote. So what does that mean in plain English? Essentially, they're looking beyond just funding trains and tracks. They want to invest across the entire railway value chain. Think suppliers, maybe logistics hubs, warehousing connected to rail, that sort of thing. It seems like they want to capture a much bigger piece of the economic pie that India's railway expansion is creating.
That does sound ambitious, a much wider scope. But expanding like that, it must require a lot of financial flexibility, right? How do they plan to manage their funding for this broader vision? Are they changing how they borrow?
That's a very relevant question. And yes, they seem to have anticipated this need. The board actually approved a new policy during the recent meeting. It's called the General Corporate Purpose Term Loan Working Capital Term Loan Short-Term Loan Policy. The name basically says it gives them that flexibility to tap into different kinds of loans for these wider corporate purposes beyond just the core project financing. And it's probably reassuring for investors that the report explicitly states there was no deviation or variation in the use of funds raised from their big R's 12,000 crore bond placement. So governance seems tight even as they plan expansion. CMD Dubey also made a point about their cost of funds. He emphasized their ability to secure an attractive cost of capital within the ecosystem of NBFCs being non-banking financial companies. And crucially, he said they're sharing this benefit directly with our customers. That lower cost of funds gives them a real competitive edge.
Okay, so let's quickly recap then. You've seen how IRFC pulled off a record-breaking quarter. Impressive income and profit, yes, but also strong underlying health. Think improved net interest margin and that standout zero NPA figure, which is really tied to their unique structure. And looking forward, there's this clear strategic shift happening. Boosted by their new Navratna status, they're pushing towards IRFC 2.0, aiming to play a much bigger role across the entire railway ecosystem, not just financing assets. So hopefully you now have a much clearer picture, not just of what IRFC achieved, but how they're positioning themselves to be a powerhouse in India's railway future.
And maybe a final thought to leave you with. Given IRFC's unique government mandate, and this clear ambition to expand beyond just tracks and trains into the wider railway ecosystem, what kind of broader economic ripple effects could this proliferation of assets, as they call it, actually have? Think beyond just railways. What could it mean for India's wider growth story, for related industries, for regional development? It makes you wonder, right?
Absolutely. Plenty to think about there. Thank you for joining us on this deep dive into IRFC's fascinating quarter. Keep that curiosity going, and we'll catch you on the next one.